Part 3 of SBR March 2020 paper. So I'll be discussing question 3. Let's read the requirements first. So there are 5. Okay. First requirement is A. The first part is, discuss with reference to IFRS whether the directors can classify the stadium as held for sale at 31st October 2005. Second, the Larry's company's accounting treatment of the crowd barrier improvements at 31st October 2005. And the principles of accounting treatment for the sale and leaseback of the stadium at 30th November 2006. Discuss Part B. First part, whether the amortization of the intangible assets relating to television program content rights by Larry Company and by the industry are acceptable policies in accordance with IFRS standards. Second, how to account for the player's contract cost, including contingent performance conditions, any impairment which might be required to this non-current assets, and whether a player can be considered as a single cash generating unit. Okay. Now let's go back. We'll be reading only for the first requirement, which is whether the stadium can be classified as held for sale. So we are not reading the player's contract cost, we are not reading the television program content right. We are only reading the background and the stadium part, right? So the first one is background. Larry Company is an internationally successful football club. Larry Company is preparing the financial statements for the year ending 31st October 2005 but is currently facing liquidity problems. Now we'll go to the stadium's sale and leaseback and improvements. Larry Company has entered into a contract regarding its stadium whereby it will sell the stadium on 30th November 2006 and immediately lease it back. So when is it selling? On wait. So they are selling on sell the stadium on 30th November 2006 and immediately lease it back. Right? Now, the directors of Larry Company wish to classify the stadium as a non-current asset held for sale in its financial statements for the year ended 31st October 2005 as they believe the sale to be highly probable at that date. Right? Sale to be highly probable. Right? So what is the issue? The issue is they want to classify the stadium as non-current assets held for sale. Which IFRS is this? Whenever you read such statement from the case, right, from your scenario of that this is right, they are classifying this one as this, they are recognizing this as this. So you immediately have to know which IFRS they are referring to, because this will help you to answer your question, right? Because you have to identify whether it's held for sale or not. So this is IFRS 5. I will write it here next to it. IFRS, they're talking about, this is IFRS 5. Okay. The sale contract requires the disposal of the stadium for its fair value, market value of 30 million, right? So what is the fair value? The market value is 30 million, and for Larry Company to lease it back over 10 years. Okay, and the present value of the lease payments at the market rates on 30th November 2006 will be 26 million. So what is the present value of the lease payment? 26 million. And it is at market rates. The market value for a stadium of this type has not changed in several years and is unlikely to change in the near future. The stadium is being depreciated by 5% per annum using reducing balance method. So it is depreciated by 5% reducing balance method. In the year to 31st October 2006, it is anticipated that 2 million will be spent to improve the crowd barriers in the stadium. There is no legal requirement to improve the crowd barriers. So there is no legal requirement to improve crowd barriers. Dairy company has incorrectly treated this amount as a reduction. So incorrectly, right? Incorrectly treated. You need to correct this amount as a what? Reduction of the assets carrying amount at 31st October 2005. And the corresponding debit has been made to PNL, right? So the mistake is they have reduced this from the assets carrying amount and made a debit to PNL. So now when you correct, what do you have to do? You have to credit the debit one, okay, the debit amount you have to credit, and you have to add it to the assets carrying amount because it has been reduced. It has been deducted. So at 31st October 2005, the carrying amount of the stadium after depreciation and deduction of the crowd barrier improvement is $18 million. Carrying amount after depreciation and deduction of crowd barrier. Right? This much information is enough for you to answer the first two requirements under A. Right? First one is whether it can be classify the stadium as a held for sale, and the second one is right. Levy company's accounting treatment of the crowd barrier improvements. What is the accounting treatment? So the first two we can answer, right? Let's see how the answer has been given for the first one, right? So first, clearly I have told you before when I was discussing question 2 that whenever this type of question is given, immediately you have to refer to IFRS, right? This is IFRS 5 they are talking about. So you have to know when something can be classified as a sale. What do you need to write? You need to write the criteria to be classified as held for sale. You need to write it on IFRS 5. What are the criteria which needs to be there for something to be classified as held for sale? Okay. So IFRS 5 non-current assets held for sale and discontinued operations address the accounting for assets which are classified as held for sale. IFRS 5 requires a non-current asset to be classified as held for sale if its carrying amount, right, will be recovered principally through a sales transaction rather than through its continuing use. If carrying amount recovered principally through a sale transaction rather than its continuing use. It must be available. Okay, that is the first criteria. Second criteria, it must be available for immediate sale in its present condition. Available for immediate sale in its present condition, and in a sale, and its sale must be highly probable within 12 months of classification as held for sale. Sale highly probable within 12 months of classification as held for sale. So this three criteria has to be there, right? Carrying amount must be recovered principally through the sale rather than continuing use. That is the first. Second one is it must be available for immediate sale in its present condition. The third one is the sale must be highly probable within 12 months of classification as held for sale. These three criteria needs to be there. Now let's see the standard only. So they are not talking about exception. Every standard, right, has some kind of exception which is there. Even this standard has an exception to the three criteria. What is it? The standard only foresees an exemption to this rule if the sale is delayed. Okay, so only one exemption is there for this rule is what? If the sale is delayed by events or circumstances which are beyond the entity's control. We have done this I think in question 1 when we were doing in the same paper, I guess. Yes, we were talking about this the exemption. So the sale is delayed by events or circumstances which are beyond the entity's control, which is unlikely to be the case in this instance. Just see what they are saying. This is unlikely. That means this exemption cannot be applied here. It is unlikely, right? So the rule is exemption to this rule. Sale is delayed by events or circumstances beyond entity's control. Okay, but in this case it is unlikely. So Larry company has entered into a firm sales commitment, but the sale will occur after 12-month threshold. Sale will occur after what? After the 12-month threshold. What does it mean? First of all, the exemption does not apply here. Then they are saying, even though the Larry company has entered into a very firm sales commitment that they are going to go for a sale, but the sale will occur after the 12-month threshold. If it was before 12-month threshold, yes, you could say that this would be classified as held for sale, but here it is after the 12-month threshold. So, therefore, what is your verdict on this? What is your conclusion? Therefore, the stadium cannot be classified as held for sale. Additionally, a sale and a leaseback, you just cannot say sale and held for sale. This is sale and a leaseback, right? The stadium. So, a sale and a leaseback transaction is outside the scope of IFRS 5 and is covered by IFRS 16 leases. This sentence needs to be there for your answer to be complete, for you to get the full marks. Now the second one is they are going to say what is the accounting treatment for the crowd barrier improvement, the 2 million which has been which has been deducted from the carrying amount of the stadium, right? So what do you need to do? It needs to be added back, and also a credit has to be there in the P&L, right? In the P&L it was debit, which was a mistake. It needs to be corrected now. So now let's see what they have written in part 2. The 2 million to be spent on crowd barrier improvements to the stadium should not be treated as an impairment of the asset carrying amount. Not to be treated as an impairment of the assets carrying amount. At 31st October 2005, there is no present obligation. Right? Why they should not be carried? You need to mention this, that there is no present obligation, legal or constructive, as a result of a past event, and there is no probable payment. Letting company may decide not to carry out the improvements. Especially, why? See, they will not decide to carry out the improvements in this case. Why are you saying this? Because they are saying why? Especially as the stadium is going to be sold and then subsequently leased back. See, the stadium they are going to sell and again they are going to lease back. Then what's the point of improving it? Right? Does not make sense. Therefore, the 2 million should be added back to the carrying amount of the stadium and a corresponding credit made to P&L. Right? 2 million should be added to carrying amount and corresponding credit made to P&L. Now the third requirement is it's a long one, right? You need to do some calculation. Let's go to the third one. Third requirement under A. So the principles of the accounting treatment for sale and lease back of stadium at 30th November 2006. You need to know what is the accounting treatment. Accounting treatment for sale and lease back. You need to know the general concept, the general accounting treatment for a sale and a lease back. If you don't know that, you cannot answer this question. You cannot relate this to the stadium. For any assets, for any non-current assets, for anything, you need to know the general accounting treatment of sale and lease back. Then only you can apply this for the stadium, right? So now let's go and read it. A sale and a leaseback transaction occurs where an entity transfers. Okay, so now they are describing when this what is a sale and a leaseback. So sale and a leaseback transaction occurs when an entity transfers an asset to another entity and leases that asset back from the buyer or the lessor. The first required criteria of IFRS standards is to determine whether a sale has occurred. This needs to be there. First criteria of IFRS standards, determine whether a sale has occurred. Whenever a sale and a leaseback question comes to you under the exam, right? In your exam, when a sale and a leaseback comes, what is the first you need to do? First, you need to check. You need to determine whether sale has occurred or not. This is your first thing you are going to write. Whenever a sale and a leaseback question comes to you, it can be in any way, right? It could be in any context, any scenario. Only the scenarios will be different. But sale and leaseback, the first step is you have to determine a sale has occurred or not. Okay. Under IFRS 16, an entity must apply. See, they are not talking about interaction of the two IFRS to IFRS 15 and 16. There are times when you are right in SBR when you are writing an answer, right? Some of the questions requires the multiple IFRS. They are not just talking about one single IFRS, not one single. Here they are focusing on multiple IFRS. They are talking about IFRS 16 and IFRS 15 together under one. You need to integrate. You need to know how to integrate. You need to know how to talk about different IFRS. They are not just talking about one, but they are talking about two. And you need to know it. You need to know both IFRS very well before you know how to integrate. So now they are saying that under IFRS 16, an entity must apply what? IFRS 15. What is IFRS 15? Revenue from contracts with customers. Remember the 5 stages? Remember the 5 stages how you determine revenue? I'm not going to go into detail now of IFRS 15, right? So must apply IFRS 15. Must apply IFRS 15 to determine when a performance obligation is satisfied. If it is concluded that the transfer of an asset is not a sale. See, now you have to answer two things. What do you have to do when it's a sale? What happens what happens when it's not a sale? You need to describe both, not just one. Okay, so now they are saying what happens if it's concluded that it's not a sale. If a transfer of assets all the time, you cannot say an asset has been transferred, so it's a sale. No, all transfer of asset is not a sale. Okay, that you need to know, and you need to know what you have to do when it's a sale or when it's not a sale. So first they are going to say when it's not a sale. Okay, so okay, if it is concluded that the transfer of an asset is not a sale, then the seller, the lessee, will continue to recognize the transferred asset. Yeah, right? Because the seller, nothing is being sold, right? It's not a sell. So the seller, they will normally, the way they will be recognizing asset, now also they will be recognizing that transferred asset. So they will continue to recognize the transferred asset, the lessor or the lessee. In this event, okay, a financial liability and a financial asset will be recognized under IFRS 9. Now they are also bringing one more IFRS. So it's not just 2, it's about 3 IFRS together. And you need to know IFRS 9 also. What is financial assets, what's financial liabilities, and all those things. So in this event, a financial liability and a financial asset will be recognized under IFRS 9. In this case, okay, in this case means what case? Under this scenario, in this question they are talking about. It seems that a sale will occur on what date? On 30th November 2006. Because of why it will occur? Why the sale will occur on 30th November 2006? How can you be so sure? Because of the binding sales commitment. Binding sales commitment. If the fair value of the sale consideration equals the asset's fair value and the lease payments are at the market rates, there is no need to adjust the sale process under IFRS 16. You need to know this also, right? So we'll see whether we have to adjust or not. Dairy company should follow IFRS 15 to account for the sale and then apply IFRS 16 to account for the lease. Two things. It's a sale and a lease back. So for sale part, you need to apply IFRS 15. For the lease part, you need to apply IFRS 16. Thus, Larry company should account for the sale and a lease back as follows. So these are the 5 steps you need to recognize. You have to account for a sale and a lease back, and make sure when in the exam you have to write like this. Don't write in a sentence, write in a bullet form like this. So it's very easy to interpret the stages, right? So there are 4, 1, 2, 3, 4 and 5, right? So the first one, de-recognize the underlying asset. If it's a sale, they are saying, right? If it's not a sale, you recognize IFRS 9 and all those things you do. If it's a sale, these are the 5 things. First, de-recognize the underlying asset because sale, right? Asset is going out. So de-recognize. Second, recognize the sale at a fair value. It's a sale. So you have to recognize at what? Fair value. Third, when sale has happened, of course, there will be a gain or a loss. So recognize only the gain or loss, not the full gain or loss. Only the gain or loss. Here you need to do some proportion, right? Recognize only the gain or loss which relates to the rights transferred to the buyer and the lessor. Only the rights transferred to the buyer and lessor. Only that proportion of gain you need to recognize. It could be a loss also. The fourth, recognize a right of use asset, right? As what? As a proportion of the previous carrying amount of the underlying asset. That means for the previous year carrying amount, right? Fifth, recognize a lease liability. When you have a right of use asset on the debit side, you will always be having something on the credit side, which is lease liability. So these five things you need to know. Now, after you write, whenever you write something, you need to, the numbers are there, so you need to use numbers. Whenever numbers are there, it is given for a purpose already. That means you need to use those numbers. Numbers are not just given for the fun. So don't think that numbers are just given just for the sake of giving. No, you need to use those numbers. Those numbers are given for you to use. Always use the numbers. So here, now you are going to, you have written the 5 points, now you are going to write it. Like you are going to use numbers. Now, Larry Company should account for the sale and leaseback at 30th November 2006 as follows. Okay, so carrying amount of the stadium. What was the carrying amount after deducting depreciation and crowd barrier? It was 18 million, but the crowd barrier was deducted. Now it has to be added back that 2 million. So 18 plus 2, 20 million. Less depreciation. Depreciation needs to be deducted from the carrying amount. What is the depreciation? It is 5% on a reducing balance basis. Okay, so 5% you take off 20, which is 1 million, and you deduct it, and that is depreciation for the year to 31st October 2006. But depreciation for November 2006, one more month is there, right? That November month. So just for 1 month depreciation you need to calculate. What will be that? 20 minus 1, right? Because 1 year depreciation you deduct, because you have to find depreciation on a reducing balance method. So you have to deduct 1 from 20, which will be 19. Take 5% of it, divide it by 12, because only for 1 month, right? And then you will get 0.07 point something, rounded up to two decimal places, so it will be 0.08. Deduct both, then you will be getting 18.92 million. Now let's go to the, you need to find the right of use asset, right? For that you need to find the present percentage. So the present value of lease divided by fair value of asset. Present value was given as 26 million in your case study, and fair value of the asset was given as 30 million, right? And you are getting 86.67%. Using that percentage, now you can find the right of use asset, right? 86.67% into 18.92, because that is the carrying amount, that is the asset. So the right of use asset is 16.4 million. Now this is given for the tutorial purpose, tutorial note. So the following will be made in the financial records. Cash is 30 million. Why? Because fair value of asset, fair value of the stadium which it will be sold is 30 million. That's why cash. Right of use asset, just now we calculated, it will be on the debit side. Stadium will come on the credit side because it will be sold, right? The carrying on of stadium is 18.92. Lease liability was given as 26 million. And finally, this is the balance, right? And it's a gain. So now the gain on the disposal is limited to the gain on the proportion of the assets sold. Recognizing that lender has retained an interest in the asset, it will be reported in the statement of profit or loss, right? Where will this gain go? It will be reported in the statement of P&L. Now let's go to part B. So part A is over. Part B, we have two things. First, we need to discuss whether the amortization of the intangible assets. So you need to know IAS. Which IAS you need to know? You need to know IAS 38, intangible assets. You need to know about everything about intangible assets, amortization, how amortization is applied, and everything, right? Relating to television program content rights by Larry Company and by the industry are acceptable policies in accordance with IFRS standard. So you need to say whether it is acceptable from two point of view. First, right? By the layer company and then by the industry. We need to know from this persons point of view whether it is acceptable or not, how the amortization of intangible assets has been done. For that we have to read only this part, not the player's contract cost but the television program content rights. So we are reading it now. Layer company has its own subscription based television station. As a result, it has material intangible assets which relate to the content rights associated with the television programs. The budgeted cost of production are based on the estimated future revenues for the television program, right? The budgeted cost of production are based on estimated future revenues for the television program. This cost of production are then capitalized as an intangible asset and called content rights. The directors of Larry Company believe that the intellectual properties in the content rights is consumed as customers view the television programs. Consequently, Larry Company currently amortizes the content right based upon estimated future revenue from the television program. For example, if a television program is expected to generate 8 million of revenue in total and 4 million of that revenue is generated in year 1, right? Out of 8 million, in total 4 million is in year 1 itself, the revenue. What happens? Then it is expected to generate, it is year 1, I'm sorry, this is the repetition. Then the intangible asset will be amortized by 50% in year 1 because 50% of 8 is 4. However, the industry practice, what is the industry practice? You need to know that also, because based on industry also you need to know whether the amortization what they are applying is acceptable or not. So industry practice is to amortize the capitalized cost of the program less its recoverable amount over its remaining useful life, right? Amortize capital cost less recoverable amount over its remaining useful life. This is the way they are going to amortize based on the industry practice. Now let's see how the answer has been given. Right? So the Larry Company's accounting policy to base amortization of the intangible asset for the content right to revenue on revenue stemming from the right seems reasonable and systematic. Right? However, IS 38 sets out a rebutable presumption that amortization based on revenue generated by an activity which includes the use of an intangible asset is not appropriate. It's not appropriate. Now let's see what further they had to say to this. This presumption can be overcome when it can be demonstrated that revenue and the consumption of the economic benefits of the intangible assets are highly correlated. So the intellectual property embodied in the television program will generate cash flows through the television channel subscription, and the estimated revenue for a television program determine the amount to be spent on producing the television program. Therefore, revenue reflects a proxy for the pattern of consumption of the benefits received. Revenue and consumption of the economic benefits of the intangible assets seems highly correlated. And therefore, because, just see, because the revenue and consumption are highly correlated, that's why. Therefore, a revenue based amortization. What method they have been applying? Lady company, revenue based amortization seems appropriate. Why? Because revenue and consumption are highly correlated. That's why revenue based amortization seems appropriate. Otherwise, it would not be appropriate. Right? Now we are going to talk about, that means from leverage company's point of view, it is acceptable, it is appropriate. Now we'll see from the industry's point of view. So the industry practice method is also acceptable and conceptually sound. What was the method? Industry method. Again, check what is the industry method. Industry method is amortize the capital cost less its recoverable amount over the remaining useful life. Yes. So they are saying that it is acceptable, conceptually sound, as it is based on an analysis of the remaining useful life of the program and on the recoverable amount. Such an approach does not contradict IS 38. IS 38's provision on revenue based amortization, because it is not based on direct matching of revenue and amortization. The useful life of an asset is required to be reassessed right? In accordance with IFRS standard, at least at each financial year end. That means they are saying that at the end of each financial year, the useful life of the asset must be assessed after every financial year, right? So where this results in a change in estimate, this will be accounted for prospectively from the date of reassessment. IS 38 also states that if a pattern of amortization cannot be measured reliably, right, straight line method must be used, right? So now we are going to go to the last one. Last one is how to account for the for the player's contract cost, including the contingent performance conditions, any impairment which may require to this non-current assets, and whether player can be considered as a single cash generating unit. There are many things to be solved under this, right? So now let's read only the player's contract cost. Right? So now let's read. Players' registration contract costs are shown as intangible assets and are initially recognized as the fair value of the consideration paid for the acquisition. However, subsequently players' contracts are often renegotiated at a cost. Also, players' contracts may contain contingent performance conditions where individual players may be paid a bonus based on their success in terms of goals scored or the success of the football team as a whole. These bonuses represent additional contract cost. For impairment purposes, Leary Company does not consider that it is possible to determine the value in use of an individual player unless the player were to suffer a career-threatening injury and cannot play in the team. Right? For impairment purposes, you need that value in use, right? So here they are saying that Leary Company cannot determine the value in use unless there's a injury or player cannot play in the team. Players only generate direct cash flows when they are sold to another football club, right? Let's see how the answer has been presented. So this is this. When a player contract is signed, management should make an assessment of the likely outcome of performance conditions. Contingent consideration will be recognized in the player's initial registration cost if management believes the performance conditions will be met in line with the contractual terms. Periodic reassessment of the contingent consideration should be made. Any contingent amounts which the directors of Leary Company believe, right? Any contingent amounts which the directors of Leary Company believe will be payable should be included in the player's contract cost from the date management believes that the performance conditions will be met. Any additional amount of contingent consideration not included in the cost of players registrations will be disclosed. Okay, see, they will not be added in the players registration cost, right? Additional amounts of contingent consideration, but they need to be disclosed separately as a commitment. Amortization of the cost of the contract, you need to be amortized, right? The contract needs to be amortized because it's an intangible asset. Any intangible assets need to be amortized, so you need to talk about amortization. Amortization of the cost of contract will be based upon the length of the player's contract, right? The cost associated with the renegotiation, they have also spoke about renegotiation, that also you need to talk about that cost as well. The cost associated with the renegotiation of a playing contract should be added to the residual balance of the player's contract cost at the date of signing the contract extension. The revised carrying amount should be amortized. How the revised carrying amount is going to be amortized? Should be amortized over the remaining renegotiated contract length. Where a player sustains a career-threatening injury and is removed from the playing team, the carrying amount of the individual would be assessed against the best estimate of the individual's fair value less any cost to sell, and any impairment charge made in operating expenses reflecting any losses arising. Finally, the last paragraph, right? it is unlikely that any individual player can be a separate. So because they told that can a single player be a cash generating unit, so the last paragraph is talking that it is unlikely that any individual player can be a separate single cash generating unit. Why? As this is likely to be the playing squad. Individual player cannot be a cash generating unit because they themselves alone cannot generate cash. They play as a group, they play as a team, as a squad, right? And also the second reason is also it is difficult to determine the value in use of an individual player, right? In isolation, you cannot find the value in use of an individual player in isolation. Why? As players cannot generate cash flows on their own unless via a sale. Cash flows cannot be generated alone by the player. Unless the players are sold to another team, then yes, the cash can come. So therefore, they cannot be a separate single cash generating unit. Right? You have to go through an IS 38 very properly, okay? Because IS 38 is a IS, like it's a standard which is which has lots of things in it, and it's little complex also in nature, right? It's difficult to understand, it's complex. So it needs to be reviewed thoroughly and often and frequently. IS 38. There are some standards which is complex like IFRS 9, IS 38, IS 16. Like this needs to be sorry, IFRS 16. This needs to be gone through over and over again, right? Some IS, some IFRS, still it's fine, right? You can let go. It does not appear most of the time, but some IFRS like IS 38 is one of it. It is intangible assets. It is one of the standard which appears in the exam regularly. Almost in every sitting, one question on IS 38 on intangible asset will be there. So you cannot let it go. So that's all for part 3. Part 4 will be coming soon. So do share this video with your friends and hope you like. If you have liked, please like, comment and share. Thank you.